But the thing that's, sort of surprising in a way to some people is that the dollar is the strongest currency. I mean, you look at the trade weighted, look at the chart of it. It's got a golden cross under it. Dollar's going up. Yeah, of course it's going up because all the other rubbish is even worse. So, but measured in gold, I mean, here I am in the UK and we've got a new socialist government. Nobody here has really bought gold. It's the one thing to have because sterling's going to go down against the dollar's going to go down against gold, interest rates or rather bond yields are going to rise, which is going to destroy capital markets completely. There's only one thing you can have when credit is collapsing, which is effectively what's happened. That is gold. And I think that's really the outlook for 2025.
The performance of precious metals through 2024 has been remarkable. Within the first 10 months, it established 41 new closing highs and reached an unprecedented peak of $2,778 per ounce in October. This surge reflects a convergence of factors, including heightened geopolitical tensions, strengthening Asian consumer demand, and sustained central bank acquisitions. Historical data since 1973 reveals gold's distinct behavior during currency fluctuations. It delivers average cumulative returns of 133% during US dollar bear markets while experiencing modest 9% declines during periods of dollar strength. This pattern underscores gold's potential as a long-term hedge against currency depreciation. According to Alasdair Macleod, a peculiar dynamic has emerged in global markets. The US dollar's dominant position stems not from inherent economic strength, but from widespread weakness in other currencies. Despite appearing strong in currency markets, the dollar's significant depreciation against gold throughout the year reveals more profound economic vulnerabilities, suggesting potential instability in the broader financial system. As 2025 approaches, several factors warrant attention. While equity markets flourish and President-elect Trump's market-friendly policies boost risk appetite, persistent concerns about inflation, government debt levels, and international tensions remain. The bond market reflects these uncertainties, with the 10-year Treasury yield closing at 4.57%, marking a year of higher yields despite Federal Reserve rate reductions. The financial landscape shows signs of potential structural stress. Market analyst Alasdair Macleod identifies escalating bond yields and deteriorating credit markets as possible catalysts for significant capital market disruptions. These conditions and evolving attitudes toward traditional currency systems may reinforce gold's position as a strategic portfolio component throughout 2025. Despite a temporary pause in momentum following the November electoral outcome, the fundamental drivers supporting gold prices remain intact. The convergence of secular demand trends and safe haven appeal suggests continued strength in the precious metal market, even amidst potentially favorable conditions for risk assets in the coming year. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
We can sort of discuss details about how, for example, the stands for delivery on COMEX are just going on all the time. What does it mean? And all this sort of stuff. But the reality is that increasing numbers of central banks do realize that the risk in their reserves is in the fiat currencies. And so, in effect, they have been selling fiat currencies to buy real money, real legal money, which, the Romans first classified as legal money in 448 BC with the 12 tables. Admittedly, gold wasn't in it then. It was sort of, copper brass type thing, and gold came later. But, and if you look at Diocletian's edicts, which I think were 305 AD, so 800 years after the first Roman laws came out. And you look at the prices, the maximum prices that were permitted under the edict. And, we don't have slave markets anymore, so we can't compare them. But there are various, things like, army boots and greatcoats and togas and, beer was another one, where the prices actually today expressed in gold are really quite similar. And that's the whole point about in money, the growth of above ground stocks has more or less kept pace with global population, averaging around about sort of 1.5–2% per annum. So it's not surprising that, there is a balance, if you like, in the whole thing, which means that the purchasing power of gold remains constant. All the other fiat crap, it just basically loses it and loses it and loses it. And it loses it. Normally it's an interesting one because the monetarists they do understand the dilution, if you like, of purchasing power of a currency, which they call monetary inflation. That's one aspect of it. But the other aspect, which they haven't really grasped, is that it actually depends. The value of a currency depends on the faith in it. And it's that faith which is now being eroded. This is why I mentioned 27% increase in the price of gold, or put another way, the dollar in gold has lost a quarter of its value in the last year, whereas money supply has only increased 3%. You know, what's that telling us? It's telling us that the dollar is actually on a very slippery slope. But the thing that's sort of surprising in a way to some people is that the dollar is the strongest currency. I mean, you look at the trade weighted, look at the chart of it. It's got a golden cross under it. Dollar's going up. Yeah, of course it's going up, because all the other rubbish is even worse. But measured in gold, I mean, here I am in the UK, and we've got a new socialist government. Nobody here has really bought gold. But it's the one thing to have, because sterling's going to go down against the dollar's going to go down against gold, interest rates, or rather bond yields, are going to rise, which is going to destroy capital markets completely.
Global financial markets experienced downward pressure as elevated U.S. Treasury yields prompted widespread equity selling, marking 3 consecutive sessions of decline. The benchmark 10-year Treasury yield surpassed 4.5% following the Federal Reserve's December 18th announcement, indicating a more gradual approach to interest rate reductions. The impact reverberated across Wall Street, with all 11 S&P 500 sectors registering losses, led by notable declines in consumer discretionary stocks. This broad-based sell-off reflects growing concerns about market valuations amid rising yields, which reached 4.641% last week, the highest level since May 2nd. Market sentiment has been mainly influenced by 2 key factors: the Federal Reserve's recent economic projections and anticipated policy shifts under President-elect Donald Trump. Specifically, concerns about the potentially inflationary effects of proposed policies, including tariffs, have contributed to upward pressure on yields. Looking ahead to 2025, financial analyst Alasdair Macleod anticipates significant challenges for the economic system. He suggests that elevated yields pose dual threats to both banking institutions and businesses. This environment may compel central banks and governments to prioritize systemic stability, potentially increasing inflation and public debt. Let's get back to the interview.
Well, I think what the banks are doing is what they've also been doing in 24. That is, they're trying to de-risk their balance sheets. Now, an individual bank can reduce its balance sheet. Point being that the leverage within the banking sector is uncomfortably high, and it became uncomfortably high because margins were suppressed at the time when we had zero interest rates. And if you look at the banking systems in Japan and also in the Eurozone, where they went, where the central banks drove interest rates into negative territory, I mean, the leverage there is far greater. So, leverage is a function, if you like, of how the banks responded to the suppression of interest rates. So they're now left with higher interest rates and too much leverage on their balance sheets. They're trying to reduce that. The system as a whole cannot reduce its balance sheet for the very simple reason that once credit is created, it doesn't disappear. I mean, people make the mistake of thinking that, we get into a deal, we do the deal, I pay you, you deliver to me, end of credit. No. What happens is the credit gets passed on to other parties. If I pay you, it goes into your bank account. And if you pay someone else, it goes into someone else's bank account. All that's credit. And even cash is credit. It's not proper money. So the point is that you have the entire system trying to de-risk itself, not by, in aggregate, reducing its overall level of credit, but by, if you like, taking funds away from the private sector and applying them to government, and specifically applying them to government through the T-bill market rather than longer-term maturities. That's the way in which the banking system de-risks itself. The problem with that, obviously, is it kills the private sector. And, Bill made the point earlier about, the falsity of the GDP numbers, because so much of it is actually the expansion of government credit, which is it's inflationary. It's not credit aimed at production in any sense. Production in the sense that the private sector is producing something that people actually want, that they will actually demand. No, this is credit which is produced by a government.
As gold continues to assert its role as a safeguard against uncertainty, the convergence of persistent inflation, geopolitical tensions, and evolving fiscal dynamics highlights the fragility of global systems. With 2025 on the horizon, investors and institutions face critical decisions that may redefine portfolio strategies and reshape the balance between risk and resilience in the coming years. How will rising yields and shifting fiscal policies influence investment priorities and financial markets in 2025? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.